Today I'll be talking about fundamental analysis and how important it is to evaluate a company's stock. I'll be focusing with the company named Capital Mall Trust. Capital Retail China Trust is the first and only People's Republic of China shopping mall real estate investment in Singapore with a portfolio of 10 income-producing shopping malls. It's listed in SGX and established with the objective of investing on a long-term basis in a diversified portfolio, primarily located in China, Hong Kong, and Macau. You must be wondering, what is fundamental analysis? Fundamental analysis is the examination of underlying forces that affect the well-being of the economy, industry groups, and company. It's used to find out the intrinsic value of stock and determine the true value of stock by focusing on various factors or parameters such as the growth, company's financial strength, future prospects, balance sheet, and profit and loss statement. The goal is to derive an estimate and profit from future price movements. At the company level that we are analyzing today, it involves examination of financial data, management, business concept, and competition. If fair value is not equal to the current stock price, it would mean that the stock is either over or undervalued. Thus, the price movement will eventually move towards the fair value. Fundamental analysis is the backbone of investing where one must perform for stock research. And you must be asking, how to perform fundamental analysis? There are actually mainly three parts for this. First, financial stability ratio. Second, performance indicators. And last but not least, the valuation parameters. First, financial stability ratio is useful to check the intrinsic financial strength of company and its cash flow patterns. Okay, we'll move on to the debt equity ratio. So this ratio provides leverage situation for companies in the sense that it compares companies' total liabilities and also the total shareholders' equity. So, broadly speaking, it should not be higher or greater than 2 or 3. Therefore, in this case, for our company is 0.7990. It shows that it has a positive ratio for this. Next, interest coverage ratio. It determines how easy a company can pay interest on outstanding debts. It's a warning sign if ratio becomes less than 2. So in this case, for our interest coverage ratio is 8.5, it will mean that the company is not burdened by that expense since its interest rate is greater than 2. So it also implies that it generates sufficient revenues to satisfy the interest expenses. Next, current ratio. It measures the company's ability to pay short-term obligation by comparing the current assets with the current liabilities. Since the ratio is less than 1, it shows that the company has a good financial health. As you can see that the current liability is greater than the current asset. Therefore, this is not a good sign and must take note. Investor must take note before investing in the company. Next, we'll move on to the performance indicator. So, performance indicator is used to check the performance of the company. Firstly, we can use to check the earning per share growth. In this case, the average annual growth rate is negative to 23.7. And this negative EPS growth is probably caused by the Treasury China Trust and Perennial China Retail Trust, which were listed in 2010 and 2011 respectively. This would also mean that because of competition, it has made our company a negative average annual growth rate. It's something that we should be concerned about as well. Next, we'll be evaluating the operating margin. So in this case, the figures for 2013 is 51.6. And these are also the past figure and equivalent estimates for the future figures. So EBDIT will mean that it's the earning before depreciations and interest and also the tax. Is that indicating that the net profitability of the operation of business after paying for various costs of production, such as wages, raw materials, etc. Therefore, a healthy operating margin is required for a company to be able to pay for its fixed costs such as interest or debt. And in this case, the operating margin is 51.6 in 2013. It will mean that for every dollar it makes, it earns 516 cents before interest and taxes. This ratio will be better if it's higher. And next is the return on assets. Return on assets indicates how profitable a company is relative to its assets to ensure the ability of management in generating profits from assets. Therefore, it means that it would be great if the company can make large profit with just a little investment. Since you can see that the return on assets is higher in the past few years than the future estimates, it would be something that investors should be concerned about, as it might mean that the company is making lesser profits with more investment. And also, since the operating margin will be increasing consistently throughout the graph here, it also shows that the operating margin will be getting higher, and this will benefit the investors. Next, I'll move on with the valuation parameters. So, first, we can analyze the price earning first. So what is price earning? Price earning is derived at current market price divided by earning price per share. So the higher forecast earning growth will have higher PE ratio and vice versa. So in this case, for our company, you can see that gradually over the years, it will be increasing, and this will also be a positive sign. And since it has a higher PE ratio, it would also mean that it has higher forecast earning growth potential. And next we can move on to the price to book. So price to book ratio is also very important for investors to actually evaluate before investing in the company. It compares the stock price value to its book value. So a lower price to book ratio will mean that the stock is undervalued or something that is fundamentally wrong with the company. So in this case, for the company, price to book ratio is quite stayed throughout the years, and also the estimate years will be around the same value. So it will mean that the stock is neither overvalued or undervalued. So next is the dividend yield. Dividend yield measures how much cash flow you are getting from each dollar invested on the equity positions. It also shows how much the company pays out in dividend each year relative to its share price. So in this case, our company is given a dividend yield that is quite consistent, and you can see from the future estimates that it will somehow increase a little bit. This would also mean that the investors have a consistent cash flow that they will be getting, which is a good sign for investors. Besides all those that I've shared earlier on, we can also analyze financial and fundamental analysis through SWOT analysis. So the first S we stands for strengths, second weakness, third opportunity, and also fourth threat. So we will now zoom in for the strength. So what does strength means? Strength means the internal factors of the company, whether the company has strong finance backing, example, whether they are cash rich, whether they have strong network, good brand names, resources, or capability. So if a company have a sensible business plan, solid management, sound financials, it will be an advantage for them. So in this case, Capital Retail China Trust has a sensible business plan. It has various continued growth strategy, such as enhancing organic growth through proactive asset management. So this basically means that they will identify improvements to the mall's retail offering, tender mix, and also carry out marketing and promotion initiatives to drive out shoppers' traffic, non-rental income. And also second, creating new values through innovative asset enhancement strategy. So simply put, the company will actively explore innovative asset enhancement initiatives to improve the returns of their malls. So to include this reconfigurations of retail units or floor plates to achieve better efficiency and higher rental potential. So the mall will still maintain their appeal to tenants and also shoppers. So last but not least is capitalizing on your creative acquisition growth model, where the company is always identifying and evaluating new creative acquisition opportunities from their secure and proprietary pipelines and other third-party vendors. So this actually helps in demonstrating a strong growth in occupancy rates, sustainable rental yield, and quality tenant and lease profiles. So these three factors have contributed to a sensible business plan which will be beneficial for the company. So next I'll move on to solid management. So for a company to succeed, it needs a top quality management. So how talented is the management team in this company, and can the management deliver on its promises? So not to worry for this company, because as you can see from the board of directors, we have Mr. Liu, and he has a background of working in Temasek Holding. Next, Mr. Lin, the chairman, has working experience in CapitaLand China as the chairperson, and also outstanding CEO overseas in the Singapore Business Awards in 2006. So with this great leaders, they will definitely lead the company well, and the company will definitely have good growth prospects. Next, I will move on to the financial highlights. So basically in China, the gross profit has increased throughout the years, and also shopper traffic has increased 5.5% and tenant sales also 13.6%. These are the good numbers, which indicates that they have future growth prospect of the company. Second, we will analyze the weakness. So in this case, the weakness is the current ratio, as the company has current liability greater than the current assets. So this is something that they should work out and also take into considerations. So as for opportunities, it's actually to the company's benefit, as it has high barrier of entry, it requires high capital, and for the threats, it will be other companies in the same industry, such as the TCT and PCRT, that were listed that caused negative average annual growth in the company. Last but not least is the conclusion. Fundamental analysis is as important as the technical analysis, as it provides overall industry outlook, and also is definitely important and essential for long-term investment, as it will give a lower risk of investing in the wrong company. So next time if you perform analysis, definitely you must include fundamental analysis. Thank you for your kind attention.